Good morning, everyone. Quick sound check. Can everyone hear me? Yes. Welcome to this Ifrs 17 webinar. This continues a series that we've been doing for a number of years now, of course, on the incredible updates of Ifrs 17. Today's one is exciting because it is the first time when we have a final standard. So this was released just a matter of weeks ago. We now have a deadline, so we know what we're aiming for. We have the amendments that have been put through after many discussions and all of the releases from late last year. And we also have some sweep issues that have been put through. We're going to go through those. So David and Nadezhda, sitting with me here, appropriately distanced, are going to talk through those, and they're also going to talk about some of the practical implications. On that note, it is a pleasure to hand over to David, who will walk us through the updates on Ifrs 17.
Thanks, Simon. So we'll start with the Ifrs 17 current status. This is the timeline that many of you who've joined before have also seen before. No surprises here, just that we now know for sure that the amendments have been published on the 25th of June. The light green bit that you see after implementation period, that is the period in which most insurers would really start their parallel runs and their testing, etc. So that's sort of the extension of the implementation period, but really everything should be implemented and all the parallel runs should start, because if you need to report over 2023, that means your comparatives start in 2022. The current status of the Ifrs as applicable in the European Union is that the standard is currently at EFRAG, so the advisory group that advises the European Commission and the European Parliament on new accounting standards, and they're currently preparing their advice on the EU endorsement. So Ifrs 9, that endorsement advice has been submitted to the European Commission, and endorsement for that, so that's the extension of the Ifrs 9 exemption for insurance companies, that is expected in Q4 2020. So that's been done for EFRAG. The draft endorsement advice for Ifrs 17, EFRAG has waited with that until the amendments were there. That is expected in early October. That will be open for comments also for a while. And then the final endorsement advice is expected early 2021. The main discussion point, and that's really a big issue now in EFRAG, is the annual cohorts for mutualized business. That's the well-known discussion on whether there should be an exemption for annual cohorts. The ISB was clear on that matter. They didn't want to have any exceptions for this, but EFRAG is not so sure yet. So there's a big discussion going on there, which might mean that EFRAG issues a qualified endorsement advice. And if the EU, the Commission and the Parliament agree, that will lead to differences between the ISB Ifrs 17 and the EU Ifrs 17, which of course would be mainly a huge hassle for insurers reporting internationally, where you have subsidiaries that, for example, do international Ifrs 17 and the group that does EU Ifrs 17. That would be very hard to deal with. The EFRAG also reports a endorsement status report. The last one was issued on the 6th of July, so that was 2 weeks after the Ifrs 17 amendments were published, but they didn't commit to any date for the draft endorsement advice or the final endorsement advice. So what you see here are just expectations, but not what has been officially communicated yet.
Yeah, which means that for the companies reporting in the EU, the standard is not really final yet. Yeah, so we'll still have to wait whether there is this carve in or carve out of the requirements for the annual cohorts taking place.
So quick overview of the final IFRS 17 amendments. What we did is we went through the changes. So the IASB very conveniently published a track changes version of IFRS 17. We went through that and we estimated the amount of changes per paragraph. So for example, if a word was deleted, that would be a 5% change. If a complete paragraph was added or deleted, that would be 100% change. So what we see is before the amendments, the IFRS 17 consisted of 325 paragraphs, of which, due to the amendments, 1 was deleted, 2 were deleted and completely rewritten, 79 were modified, 51 paragraphs were added, which leaves us with a total of 375 paragraphs. The scope was affected, so there were 6 new paragraphs on that. Some definitions, presentation and disclosure was affected. Effective date, of course, much discussed. And due to the changes, also the illustrative examples had to be changed.
Yeah, and probably one comment from my side as well, if when you look at the paragraphs that have been added, interestingly, almost 20 of those relate to just acquisition costs, which show how little guidance was available actually on the acquisition costs in the initial version of the standard. And also probably if you look at the overall extent of changes, you may see that pretty much 35% of the standard, final version of the standard has been modified in one way or another through the amendments. So still quite a bit of changes.
Yeah, exactly. So that is the pie chart on the right. There you see our estimation on the bottom of how much changed per paragraph. So that's, so yeah, those 245 paragraphs that weren't changed, 51 paragraphs that were changed completely, the gray part of the pie, and the rest was changed, yeah, somewhat. All right, quickly go through some of the key changes. Of course, most of those have already been addressed during this IFRS 17 update. But it's good to quickly go through what finally got into the standard. So assigning coverage units to insurance and investment contracts for GMM contracts. So contracts without direct participation features, there could still be investment services provided. That wasn't taken into account in the first version of IFRS 17, but the amendments changed that. And now if there's also investment services there, then you need to take those into consideration when you determine your coverage units. So the spread of your profits over the coverage period of the contracts. Acquisition cash flows, like Nadezhda said, a lot of the changes apply to those, because now future renewals need to be taken into consideration. Because what happened if you had huge marketing costs for a new product, your first year annual cohort would be very loss-making, because all those costs would be assigned to that first annual cohort. And after that, you would have a hugely profitable product, which of course didn't reflect reality, because your marketing costs applied to those future groups as well. So the IASB now requires you to estimate the amount of future renewals and spread assign the insurance acquisition cash flows to those groups, and each period assess if that asset that you booked for those costs is still recoverable. The interim reporting, so there you had to, if you reported on a quarterly basis, for example, then you had to lock in your estimates at each quarter, and you weren't allowed to update those. That was contrary to what was happening currently at a lot of insurance companies. So that was a huge effort to change that. So now you have the option to unlock your estimates and basically apply year-to-date accounting for those. Yeah. The Vfa eligibility was basically a clarification that the eligibility for VFA, the contract eligibility, should be assessed on a contract level instead of a group level. So you should really look at the contract and apply the Vfa eligibility criteria to that contract and not to an entire group of contracts. Risk mitigation applicability was widened. At first, it was only for derivatives, and now it's been expanded to non-derivative assets at fair value through profit or loss and reinsurance contracts held. The reinsurance contracts held here on initial recognition under the original standard, it could be that you had to take the losses on your insurance contracts immediately, but you could only book the recoveries on those contracts that you had reinsured. You could only book those reinsurance recoveries later. So that meant a mismatch between your losses and your recoveries. And that was corrected so that now if you book a loss at initial recognition for insurance contracts, you can also book the recoveries as a plus at the same moment. And for the transition to IFRS, there were, so for contracts that you acquire after the transition date, which are in the settlement period, the ISB determined that the insured event is actually the determination of the ultimate cost. That means for groups of insurance contracts that you acquired, you had to book LRC. Initially, you couldn't apply LIC, even though the insured event had already occurred, because it's about contracts that are in their settlement period. So the insured event for the policy had already occurred, but you need to book an LRC for those because you acquired them. So the insured event is actually the determination of the ultimate cost of the contracts. But the transition relief here is that on transition, if you have those types of contracts, you're still allowed to book LIC for those contracts, which doesn't apply after transition period. So that's a quick overview of the amendments. And with that, I would like to hand back to Nadezhda.
Okay. Thank you, David. So that has been a reminder what the main amendments have been, and what we'll do in the subsequent section is also to look at what are the implications of those amendments on the implementation process, different aspects of the implementation process. However, before passing to the impact on implementation, what I'd like to talk about are the so-called sweep issues for IFRS 17 amendments. Why? Because, well, you probably remember there have been 3 main sessions that were scheduled by the ISB in January, February, March to complete the set of main amendments. However, in May 2020, there was another session with the so-called sweep issues, where ISB and the staff looked at further modifications, which are normally considered to be minor. So that is what we will go through now, because we haven't covered that in our previous webinars so far. Before I move on, though, can I check if anyone has any questions to what we've just discussed in the previous section? Can I ask someone to raise their hand just to check whether the function is working? Okay, good. Perfect. Thank you. Good. Good. So then, please, if you have questions as we go, don't hesitate. I mean, it's not just at the dedicated Q&A session that we will be discussing those, and hopefully we can bring back a bit of the interactiveness we've had in our live breakfast events. Good. So speaking about the sweep issues, I mean, normally those are considered to be fairly minor. So that means they can be fixed easily. And then, well, might normally be the case. However, if you look at the list of those sweep issues that were then integrated into the final version of the standard, you will see that some of them are quite impactful and relate to important changes, such as, for example, applying the risk mitigation option in combination with the OCI option for participating business, for VFA business. Then how you treat changes or differences in non-distinct investment components. So what is the change that you would be taking to the CSM for the non-distinct investment component? Then further specifications about the pre-recognition of acquisition cash flows, but also other cash flows, so not related necessarily to acquisition costs, and also definition of the liability for incurred claims. And these are the changes that we'll go through now. The first one relates to the application of the risk mitigation option. So the issue is that the risk mitigation option allows you to match changes in financial risks, financial assumptions that you would normally recognize in the CSM for the VFA business, for the business with direct participating features, with whatever risk mitigating instruments you are using. And those risk mitigating instruments may be either derivative instruments, or it may be financial instruments that are measured at fair value through P&L, or those instruments may be reinsurance contracts held, right? So in this case, any changes in those instruments in financial assumptions would normally either be taken into the P&L as it applies to the derivatives, or then to the financial instruments through P&L, or it may be taken, those changes in financial assumptions may be taken through P&L and partially to the OCI if you're applying the OCI option for your reinsurance held. Okay, so in combination with the older definition of the risk mitigation option, that could actually lead to some mismatches, because if for your VFA business you have selected an OCI option, you would be required to split your movements in insurance liabilities between your P&L and also OCI. That means actually you would have more of a mismatch, even if you would be applying that risk mitigation mitigating option. Okay, so because of that, staff has proposed to change the wording in the standard to ensure that companies can take full benefit of the risk mitigation option, which means that if you have a VFA portfolio and you apply an OCI option for that portfolio, right? At the same time, you're applying risk mitigation option for the same portfolio. That means that any changes that you would recognize as covered by either derivatives or financial instruments through P&L, you can reflect in the P&L. So you don't need to split those changes between P&L and OCI, okay, as the OCI option would have required. So then you will have a match to the extent possible, within your P&L for the risk mitigation option. Now, if you are applying reinsurance held as a risk mitigating instrument for your VFA portfolio, that means that changes in financial risks and assumptions from the underlying VFA portfolio would also be split in the same manner as changes in your insurance held. So you would split them between P&L and OCI, but on the basis that you apply for your reinsurance held. That allows you a better match of your results in the P&L. And overly, the option itself allows you to take the losses, for example, that you would be incurring because of unfavorable changes in financial risks you would otherwise take in your CSM, and that might cause onerous groups of contracts to appear. You could be taking directly into P&L and mitigate those losses by those different instruments, derivatives, financial instruments through P&L, or reinsurance held. Any questions here? Okay, if no questions, I'll then proceed to the next topic. If you can. So the next relates to the treatment of the non-distinct investment component. And what this sweep issue was intended to clarify was how to calculate an adjustment to the CSM when the amount of the non-distinct investment component that actually becomes payable in the period is different from the amount that you expected to pay in the future. And the difference is driven actually purely by the time value of money. So it was clarified that the difference that you would take into your CSM in the general model should not consider any differences due to the time value of money. So your CSM should not be adjusted for those differences. And then the standard provides the guidance how you would calculate that difference that you would be taking to the CSM. Any questions here? Okay. Good. Now, the favorite topic of the acquisition cash flows. And I mean, as I've mentioned, I was really quite surprised to see how much of additional guidance was included in the standard. I mean, it clearly shows that, the accounting side of things for acquisition costs has not been really considered in the initial version, and that's why so much guidance had to be added. And that related to both treatment of the acquisition costs in the business as usual when new contracts are incepting, then treatment on transition, where all of the requirements for different transition approaches have been added, and also treatment in case of transfers of business and business combinations. However, the sweep issue that we are talking about here relates to something different. And again, a more specific item. It can well be then afterwards in a couple of years, we get some further amendments on the acquisition cash flows as the practice develops. But this one relates to actually two aspects. So one aspect is that it has become clear that all other acquisition cash flows that may be paid before the group of contracts is recognized have not been dealt with specifically, even though that was kind of implied from the standard, but specifically those were not treated. And now it has been clarified that that other cash flows, may those be resulting in assets or liabilities that happened before the initial recognition of the group of contracts, should be treated in the same manner and then considered when you are calculating the balances at initial recognition of your groups of contracts that may relate, for example, to the prepaid premiums that would become a liability before you initially recognize your group of contracts. So that has been clarified on one side. And on the other side, another topic that also has been a subject of discussions quite a bit relates to the recognition of accrued, for example, acquisition costs, because initially the standard was talking just about the actual cash flows paid. And the question that remained open is, how do you deal with any accrued acquisition cash flows where the payment has not happened yet, and probably you don't even have, an invoice. You have accrued it and recognized that liability towards the agent, for example, based on a different standard. So that has been now clarified in the standard as well. It says that either that asset for acquisition cash flows should be based on the cash flows that have taken place already, or if liability for those have been recognized based on some other Ifrs standard. So that is a clarification that has been made based on the sweep issue. Again, not necessarily minor, because I can recall it was causing quite a bit of discussions in the industry as the standard was just issued. Any questions here? No? Okay. Good. Now then, another topic that was also subject to quite a few discussions that relates to sweep to definition of the liability for incurred claims, which has been adjusted directly in the defined terms of the standard. Initial proposal of staff included specifying that the liability for incurred claims would also include non-distinct investment component, but then it has become clear that the liability for incurred claims is not just liability for settling the claims and non-distinct investment components, but also other costs that may be related to fulfillment of the insurance contracts. So that has been also now clarified in the definition in the standard, and then answers like the question that has been also raised by the industry since quite a while: what should be in the liability for incurred claims and what not. Okay, any questions here? Also, yes. Not in the, yes?
We have a question. On NDIC, in the case of experience refunds or similar structures for L&H, it does not seem possible to define actual and expected periodically, only in total. This is because these NDIC are not cash flows, they are characterization or label for other cash flows, either expense or claim depending on results. The conclusion is A is E in all cases. Have you seen this dealt with at other clients?
Yeah, I see the point. I think it's more typical, like that depends on the industry. That's what we see as well, because in particular in reinsurance, that would also depend very much on how you define your NDIC, and you might ultimately end up with your NDIC always be equal. You expect it always be equal to actual per definition. What comes into play potentially is the volume difference, because if you estimated a different volume of business and then calculated your NDIC as a percentage of that, there may be a difference. Most likely then this difference would not be caused by the difference in the time value of money. That would just be a pure difference in volume, and then the question is then how it is factored into your analysis of change specifically, and then the resulting differences. But yeah, I mean, this is seen across the industry. I would say more typical for reinsurance, but not only. So then we can proceed to the next set of sweep issues. So these ones we have put together. Could you please go back? So the two other sweep issues that have been brought up in May 2020, they relate to reinsurance contracts held and how you identify losses on the underlying contracts, because the concerns raised by the industry were related, or by staff as well, related to the fact that you may have within one group of underlying direct contracts, you may have contracts that are covered by the reinsurance contracts held, and then there may be this loss recovery component resulting from that, and there may be other contracts that are not covered by the reinsurance held, and therefore there wouldn't be a resulting loss recovery component, and then the respective P&L effect. So how do you go about those? And the answer to that was that, well, companies need to use a systematic and rational approach, a method to calculate those, but you do not need to track that attributable loss on a level lower than your group. Yeah, so you can calculate that amount for the whole group of the underlying direct insurance contracts, and that would be sufficient. Other concerns were also related to the fact that identification may be easier at initial recognition, but more difficult subsequently. And then again, initial wording was suggesting that you should be using exactly the same method at initial recognition and subsequent measurement, but afterwards the wording was softened a bit, so that acknowledging the fact that the level of information, the granularity of information you may dispose of at initial recognition may be different compared to what happens subsequently. Okay. And then another change that relates to the recognition of income tax. So specifically thinking about the tax payments that are then chargeable to the policyholder under the terms of the insurance contract. There was some inconsistency in the text that was not allowing directly to recognize that part of the cash inflows received in your revenue and then subsequently in the expense. So that means that the companies would need to recognize that portion of cash flows as other revenue separately from the insurance service result. That has now been clarified and will allow putting those inflows and then outflows in your insurance service result in revenue and expenses respectively. So to allow the correct representation of the result of the volumes of business written in the period. Any questions here? No. Okay, so with that, we can proceed into the impact on implementation from the final amendments on the standard. And I mean, the way we were thinking about that, there are different aspects that you may be considering. Clearly, when you think about what the amendments have brought, I mean, generally you can say that, well, the industry has welcomed the amendments that were improving or simplifying the standard overall, and clearly did not welcome whatever amendments that were also discussed and pushed for by different bodies that were not accepted by the ISB, such as annual cohorts, for example, right? But what we have been trying to do is to look at specific aspects on the implementation. We have selected just 4 of those aspects to look at, and we can proceed to the next slide for that. Do you have a question? Sorry. Nope. Okay. So we have looked at the 4 main aspects. We have looked at what's the impact for the data that you will need, what's the impact on the calculations or the complexity of calculations that need to be conducted by the companies, what's the impact on being able to standardize the processes, and impact on results, or, well, capacity to impact the results.
This overview is, of course, quite subjective and might differ per insurer. So we're very happy to hear your feedback on these points. And yeah, because we can imagine that for you, it will be different than what we state here.
Yeah, and then here we would really welcome a discussion from your side. And also one aspect that we didn't touch on or didn't analyze specifically was the time it will take to implement. Yeah, because again, that will, so whether that increases, for example, your time to final implementation, or decreases, because that is very individual, again, by company and the way or the stage you are currently at. But yeah, very welcome to have a discussion here. So again, remembering the topics that David has presented earlier. So when thinking about the possibility to assign coverage units to insurance and investment activities, what we all think is that this amendment was already expected by the industry. So any data requirements were pretty much clear already before that amendment has been finalized. So, well, it does require to make certain additional assumptions. However, that is not something that can be considered as a completely new data requirement at this stage. Yeah, the calculations are expected to become more complex as a result of that amendment. And again, the weighting between the different components of the service provided requires quite a bit of judgment. Since the calculations are becoming more complex, we do not expect that it will contribute to more standardized calculations within the solutions that are being currently deployed. And then in terms of impact on results, we would expect a bit less predictability on the results due to complexity, but clearly there may be different opinions depending on which methodology you are choosing to apply for your specific business and how you choose to allocate those different components for your business.
Yeah, I'll just add a couple of comments that Nadej there. So this is one of the main topics which has evolved over the last few years. And if we go back 2 or even 3 years, there was certainly a section of the industry globally that expected that coverage units were going to be a sum assured, or potentially a sum at risk, for example. Switzerland and Germany in particular have had long discussions around whether there is an alternative view of that and whether coverage can be seen in a different way. It has become very clear now that there are going to be differences in the way that coverage units are defined and then applied, and that those are being accepted by auditors, by industry bodies, for example. Or maybe just a pertinent point for Switzerland, very related to a discussion that's coming out of Germany. One of the challenges with the savings business, which is so common here on the life side, is that there is an additional return on the underlying assets, which is not included in the discount rate. And as that additional margin is released over time and earned over time, at the moment, it would flow into the CSM. And so the CSM would actually naturally grow just because of this margin, which is effectively driven by the fact that the accounting policy for the discount rate says that you cannot include expected spreads in the discount rate. There is talk now about reflecting an expectation of that spread inside the coverage unit. And if that happens, then the coverage unit can be used to modify the emergence of the profit and modify the way that the CSM grows. So almost to one of the points on the screen, this is actually very beneficial. So the flexibility here is helpful. There is a lot of discussion still to come, but this definitely needs some numbers. Okay, so the impact here is to recognize the flexibility and then run through the numbers. There are more options now. See what the numbers do to the opening shareholder equity, see what happens to profitability, and then work out what is the best thing and the most appropriate thing for your business together with the auditor. So lots more, I think, to come on that one. Nadesha?
Yeah, thank you. So continuing with the next amendment relating to the interim reporting. So just to remind, it did allow for optionality now in the application of the standard. So the companies can either lock their estimates with the same frequency as their interim reporting under IAS 34, or the estimates can be unlocked throughout the year. So considered on the year-to-date basis. That means that within any interim report, after any interim reports are prepared, the subsequent period would continue revised estimates for the previous reports as well. So the option is available. It was done based on a lot of feedback from the industry. So in terms of data, it is considered that for many companies, the chosen approach is better aligned with the current process. So actually, it's simpler to provide the data that is required. I would say it's not necessarily the same for everyone in the industry. So for some reinsurance companies, it also might be a challenge, particularly as looking at P&C reinsurance business, because that's not necessarily how their processes operated before. For anyone who has live business and live participating business, clearly the year-to-date option is more beneficial and hopefully more aligned with their data availability. Again, in terms of calculations, similar, it is considered to be better aligned with the existing actuarial processes. Clearly, the open question is still how frequently will you update your actuarial assumptions throughout the year? I mean, it's a related question, not necessarily related to that specific option, but that's a question that needs to be addressed as well and resolved in the industry. And the other challenge for the calculation, and I think to me it also links to the standardization, the option for the unlocked estimates across the year. So the year-to-date view is not yet included in all of the subledger solutions. So you might still be in discussions with your provider when will that option be available and allow the proper testing of that option and seeing how the results are being generated with the option being included. Apart from that, expected to allow for better standardization as well, considering alignment with the current processes, especially for life, especially for direct participating contracts. In terms of impact on results, again, hopefully that better aligns with the possibility of reflecting the actual performance for the year on a year-to-date basis in a more appropriate way, closer to how the business operates.
Yeah, the point about subledgers is interesting. So most subledgers are built assuming an accrual basis, whereby the current calculations depend on what was reported in the last period. And so they build up from the last period. And in this case, if you choose the alternative option to unlock, then you have to go back further in time. So the subledger would need to store calculations from further back and then build on those calculations rather than the ones from the immediate past period.
Yeah, so just in case you haven't discussed that with your subledger solution provider, it would be time to do that now, because again, in the standard solutions, it was not available. So very much depend on which solution you're looking at now. Good. And any questions here or any disagreement with how we see it? Okay, then I will proceed to the next one. So acquisition cash flows, we have spoken quite a bit about them already. Now, what all of those additional 20 paragraphs would imply that there is additional data that needs to be collected, not necessarily collected previously. So all estimations need to be built with regards to the expected renewals. And then the allocation of the acquisition cash flows need to happen in a way that it can be also subsequently audited. So again, systematic and rational way, as the standard says. For the calculation now, in addition, impairment calculations would need to be required, and there are also additional disclosure requirements on the time band on when do you expect to allocate those acquisition cash flows for future renewals to your results. So it's again like an additional estimate that needs to be made. In terms of standardization, probably would be difficult. Again, that's not necessarily something that, well, the subledger solutions were thinking of in the first place. And then it's unlikely that this process, especially when you think about impairment, can be standardized, very, very standardized. In terms of results, there is a certain level of subjectivity involved. So there may be a wide range of possible results, not necessarily always comparable between companies, and how the requirement is being applied and how those future renewals are being identified. Then the risk mitigation option, again, well, it has been expanded. It has been clarified how it should be dealt with when you're using the OCI option for the VFA portfolios. So when thinking about data, I mean, there is a need for additional data to be collected in order to be able to apply the option, because what you will need to do is to identify which portion of the changes in your financial assumptions that is affecting, well, the CSM or the fulfillment cash flows is covered by those risk mitigating instruments, be it derivatives, be it financial instruments through P&L, be it reinsurance contracts held. So that data needs to be identified, well, and then that also directly impacts the complexity of the calculation, okay? Because the setup, there probably will be no one-to-one match if you're looking at the whole group of your contracts with whatever risk mitigating instruments you're using. So you would need to carve out, well, basically identify those changes that are covered by those instruments. And clearly that would also require more documentation to be able to apply the risk mitigation option in the first place. Yeah. So in terms of standardization, well, potentially can be standardized, would very much depend on what are the underlying actuarial processes, and then possibility to implement that in the subledger, so to be discussed. The positive thing, though, is that in terms of impact on result, it is allowing to present a smoother result and to better mitigate the fluctuations in the P&L because of the application of that option and a wider range of instruments available for the option. Any questions here? No. Okay. Good. So looking at reinsurance held and how the losses are being offset based for the underlying onerous business. So the data, I mean, likely the data is probably available already, but again, looking at the sweep issue that we have, well, looking at the amendments that we've just discussed, right? So you would need to identify those changes, because of the way the contracts are being grouped, probably that will be more of a challenge at subsequent measurement compared to initial recognition. So at initial recognition, that is expected to be less demanding. Subsequent measurement, probably more difficult to identify those movements within a group of underlying contracts. So tracking those changes also from the calculation perspective. So we'd expect that potentially be standardized by means of mapping, but that probably, even though the standard does not require tracking that on an individual contract level, probably that would still require in practice mapping on tracking those changes for individual single contracts to be able to evaluate those movements reasonably and reliably. In terms of impact on results, so this is what the industry has been aiming for, to have less volatility of results, and in particular better matching between the development of onerous losses and the related reinsurance coverage. Good. And then the Vfa eligibility, so the clarification that the assessment for the Vfa eligibility needs to happen on a contract level. Well, this is basically where we would expect your auditors to be now taking a closer look at how the Vfa eligibility has been defined. I do know that in the industry, probably a lot of companies are expecting that that should not have a significant impact on the conclusion that they will make on the eligibility based on the way the standards are, the contracts are set up. So again, it would require bit more of documentation to prove that concept, and then make sure that that assessment is also auditable. In terms of standardization, again, expected to be, required to be happening at a contract level. So probably less of a possibility to standardize that process, especially if new products are coming into play. And impact on results, as I've mentioned earlier, because it is expected that this requirement will not significantly change the conclusions the companies have already made on the Vfa eligibility. Only a limited impact on the results is expected. Yeah, and as I've said previously, I mean, we have not looked at the timing, like at how longer will it take you now to implement all of those changes. That very much depends on your working assumptions and on how much those have been factored into your initial project setup. So may take different time. Okay, so with that, we have some time left for your questions. So if you have any, that would be now the right time to ask those.
Please do raise your hand virtually if you have something, or just type into the chat. Okay, I did have a question I'm going to ask my fellow panelists here. The EFRAG endorsement advice, once that has been written by EFRAG and passed to the European Commission, the European Parliament, is that effectively the EU view? Or does that ever get changed by the European Parliament, for example? Do they ever reject it? I'm just thinking about what is should we be very focused on what is written in that advice document? Is that almost the end point? Or is it possible to have more change?
I'll take that one, Simon. It has not been seen that the EU amends an endorsement advice. However, what we expect is that the EFRAG is not going to issue the final endorsement potentially until the very end of 2021, similar to IFRS 9, which was approved, I think, 7 weeks before 1/1/2017 when it became effective. So we're going to be looking at a nerve-wracking process, and then the question is going to be, is it going to be carve in or is it going to be carve out? Carve in is very unusual. That would mean that EFRAG will recommend an amendment to the standard, and they become accounting standard setters effectively, which is very unusual. But they may decide to do a carve out similar to what they did with IAS 39. And that would be, as David mentioned, troubling for some multinational insurers and a problem.
Indeed.
But we are, I mean, what we are seeing is the industry continues to exercise more pressure on EFRAG, and EFRAG is divided. The answer is not, we can't predict the answer at the moment.
I find it fascinating watching the discussion, which is really now focused on the annual cohorts for mutualized business, because both sides are almost getting more and more direct. So there was a letter that was sent by, I think it was 6 or 7 European insurance bodies just a couple of months ago. Again, a very short letter, but reiterating the need to remove the annual cohorts for mutualized business. But at the same time, the ISB is talking very openly on social media and writing articles about why it's so important. It does make me wonder, and this is a personal view, so please don't anyone write this down and say it's Deloitte, but it makes me wonder whether there could be a compromise whereby the calculations potentially are changed to be less cohort specific, but I can't imagine the ISB not then requiring the disclosures to be much more clear about how different annual cohorts are producing cash flows which influence the overall result. And so it just makes me wonder whether there is something that could come out that has additional focus on the disclosures and possibly a little less focus on the calculations.
I think that's correct. I agree. I think ISB has now put a stick in the ground. They will not budge and they will not change the standard. That's our expectation. Now let's watch what EFRAG is going to do. But I believe there will be an emerging practice. And I think that practice is going to differ country to country. And the industry is going to have to will find the ways they do usually with standards like that to converge, if you will, with time on the approaches they're using. But yeah, disclosures potentially will be the way things are going to be made more transparent of how the principle has been applied.
Good. So with that, I mean, we are pretty much out of time. Thank you very much for joining today. And as usual, if you have any further follow-up questions, please feel free to reach out to any of us. And just a quick announcement as well from our side so that you can probably put that into your calendars already. We are planning the next webinar. I mean, unless it is allowed to take it in person again, but well, let's assume that's probably a webinar again. It's going to take place on the 17th of November. So we'll be very happy to see you joining this one. Thank you again for being with us today. Hope to see you soon and enjoy the day.